Hey guys, welcome back to the channel where we teach you everything that you need to know to becoming a consistently profitable trader. Volume spread analysis is one of the most essential concepts to becoming a profitable trader, as it gives you a lot of insight into the momentum of a market. Using volume is excellent for identifying how strong a current trend is, as it will highlight the interest of buyers and sellers. And of course, as with most trading indicators, it can actually give you false signals when used by itself, but matching with other confluences, it can actually give pretty good results. In this video, I will be highlighting volume mixed with certain candlestick patterns that can help to predict when a trend will continue or reverse. And before we get into it, I would like to ask you to drop a like if you want to see more content like this, and subscribe to the channel if you are new and want to someday become a master at trading. Down thrust. The down thrust is when there is a bullish pin bar or doji bar having a ultra high volume or above average high volume. The spread of the down thrust bar is extremely low while the volume is relatively high, and the divergence between the candle spread and volume signifies that there is more demand than supply, causing prices to reverse in the future. Selling climax. The selling climax occurs when there is a high spread bearish candle closing well off the low, having a noticeable downward rejection wick, and the corresponding volume is extra high or above average. Sellers try to push the market lower, but it is heavily rejected by buyers, and the selling climax has a downward wick whose size is approximately 25 to 50% of the candle's body size. Bearish effort less than bearish result. The spread is larger than the previous candle spread, but its volume is actually lower than the previous candle's volume. The divergence between price and volume signifies that the market will reverse to the other direction soon. Bearish effort greater than bearish result. The spread of a bearish candle having a spread that's lower than the previous candle spread, but in contrast its volume is actually higher than the previous candle's volume. The divergence between price and volume again signifies that the market will reverse soon. Inverse down thrust. Inverse down thrust occurs when an inverse bullish pin bar or doji bar has a low spread but its corresponding volume is high or above average. The divergence between price and volume signifies that the price will rise soon. Failed effort selling climax. This occurs when there is a bullish candle with a higher spread and volume than the previous candles. However, the next candle is bullish, observing the entire bearish result. This usually ends with price continuing to go higher following the bullish candle. Upthrust. Upthrust is when there is a bearish pin bar or doji bar having a ultra high or above average high volume. The spread of the down thrust bar is extremely low while the volume is relatively high, and the divergence between the candle's spread and volume signifies that there is more supply, causing the price to fall in the future. Buying climax. The buying climax occurs when there is a high spread bullish candle closing well off the lows, having a noticeable upward rejection wick, and the corresponding volume is also ultra high or above average. Buyers try pushing the market higher, but it is heavily rejected by sellers. The buying climax has a downward wick whose size is approximately again 25 to 50% of the candle's body size. Bullish effort less than bullish result. This is where the spread is larger than the previous candle spread, but its volume is lower than the previous candle's volume, and the divergence between price and volume signifies that the market will reverse soon. Bullish effort greater than bullish result. The spread of a bullish candle is lower than the spread of the previous candle. However, its volume is higher than the previous candle's volume. Again, the divergence between price and volume signifies that the market will reverse soon. Inverse upthrust. This is an inverse bullish pin bar or doji bar having an ultra high or above average high volume. The disagreement between spread and volume signifies that there is more supply than demand, causing the price to fall in the near future. Fail effort buying climax. This is a bullish candle having higher spread than the previous candle as well as higher volume than the previous candle. However, the next candle is bearish, observing the entire bullish momentum, which usually results in prices continuing to fall in the future. Okay guys, so that's it for today. As I said, volume spread analysis is best used when combined with other confluences such as supply and demand zones, moving averages, support and resistance, or any other indicators of price action that you are comfortable using. So that is it. If you did learn anything from this video, go ahead and drop a like and subscribe if you're new. See you next time.